I've spoken before about how central banks view employment and how looking at growth rates of employment, particularly year-on-year growth rates, give you a feel for how central banks, particularly the Federal Reserve or the RBA, are feeling about the economy. Now, this is not our model of short rates. Our model of short rates is inflation, unemployment, and inflation expectations. That's completely different. But this, if you look at when employment growth, year-on-year employment is growing faster than the long-term median, then you'll see that central banks tend to increase official rates during periods like that. And when year-on-year employment growth is growing slower than the long-term median, then central banks will tend to cut rates in periods like that. So what we've got now is a picture for you of the year-on-year growth of US payroll, US employment growth. And we can see that the long-term average for the last 2 decades for this is 1.6%. Now, quite recently, 6 weeks ago, there was a lot of media coverage on the employment number, and the market fell heavily, and people said it was because the employment number was so bad. And at that time, I showed you this chart, and at that time, year-on-year employment growth in the US was 1.6%, which was exactly the same as the long-term median, and therefore there was no reason to panic. Since then, in the last week, we've had more discussion of downward revisions of US employment growth. And so what we see in the chart today is that there is a very imperceptibly small downward revision of a downward movement in the rate of growth of employment. It has fallen from the long-term median of 1.6% all the way down to 1.5%. That's right, 1/10 of 1% decline. So that's hardly anything to panic about. But if we look at what's happening in the history of US employment, we can see that there's been a lot of big cycles since 2019. Back in 2020, employment growth in the US slumped by 13.4% in 1 year to April 2020. Then it recovered in April 2021 by 11%, a big rise in only 1 year. And then there were further oscillations, but they calmed down a bit. The rate of growth declined to 3.8% by October 2021, and then it kicked up again to 5% employment growth for the year to February 2022. And after that, there was a long-term gradual decline in positive growth rate, slow but gradual decline in the long-term growth rate. And that reached a bottom back in February this year, where the growth rate, year-on-year growth rate of US employment had declined to 1.76%. And around about that time, the Fed was very optimistic about cutting rates, and the market was very optimistic about cutting rates. But hey, what happened was the following month there was a surge in employment, and an increase it bounced up by about 1% to 1.8%, 8.86% year-on-year growth rate. And that put the Fed on hold for a while. But what we've seen as we've come into the second half of the year is employment growth is slowing down. 6 months ago, there was 157.7 million jobs or people employed in the US, and now including the most recent number, there's 158.7 million 6 months later employed for the most recent number. Still positive employment growth, but it's now increasing in that 6 month period of a rate of only 0.71%. So in the 6 month data, we can see employment growth is slowing. We can see that in terms of the year-on-year growth rate, it's now less than the long-term average, marginally less than the long-term average. So I think we can confidently forecast that when the Fed meets again and we next see Jay Powell present on the 18th of this month, he'll be announcing a cut in the Fed funds rate of 25 basis points. Just 25 basis points, not no need for anything larger than that. And at the same time, as he announces that cut of 25 basis points, what you'll also see is the Fed will release its summary of economic projections. And in the summary of economic projections, the Fed will tell us where it thinks interest rates are going in the period ahead. Not the people who want clickbait, not the people who want headlines, but what the Fed itself thinks about where the Fed's rate is going. And when that happens, I'll talk to you again about where the Fed feels where the US economy is going and where rates should go as well.